Hi, I'm Roy Reyes. Welcome to this channel, Your Money. Today I want to talk about the history of the dollar. As you see from my shirt, I'm old school. So I like to go over the history because history tends to repeat itself. We see the same patterns over and over. Like King David said, there's nothing new under the sun. I do remember a movie I saw, it was called The Manchurian Candidate, I believe. It was some astronaut that went to space and, he got possessed from some alien or something. The point is, when he got back to Earth, he looked the same, but internally he was completely something different. And that's exactly what's happened to the dollar before, and it's going to happen again. It's gone Manchurian. I do remember some years back when I lived in Miami, a friend of the family, this older gentleman, um, he knocked on our door once. I opened the door, the guy was out of breath, and he said, "Oh, I found some money in the bus," and I ran. So he had like this little bag of money. It was some money from some South American country. It was like hundreds and thousands in denomination. And after looking at what it was worth, you couldn't even buy a Happy Meal with it. It was like 25 cents. Of course, that's an extreme of a coin that's been abused, but unfortunately, the dollar, we already took the exit, okay, down that road. So that's what I want to talk about today. Thanks. Okay, so yeah, all throughout history, there has been like some main money system. In ancient Athens, it was the drachma, and then we had other coins like in the Roman times. We also had the denarius. Most of these coins were made out of precious metals, so they're even worth money today. So they found some of these coins, and that you can still buy a lot of stuff with it. So then, in modern times, it's been the British pound, and more recently the U.S. dollar around World War II time frame. In 1717, Britain adopted the gold standard, meaning that the central bank can only print out money if they had the backings in physical gold in the warehouse. At that time, 60% of the whole world's commerce was done in that coin. Later, in 1862, the U.S. Came out with their first money bill, and people called it the greenbacks because they were green in the back. So at this time, you can buy with 20 of these dollars, you can buy an ounce of gold, and actually held that value for 139 years. Pretty impressive. Then we come around 1873, and there was a big panic. Okay, so what happened was, there was a depression from 1873 to 1879. This was known as the Great Depression until later on a Greater Depression came up in 1930s. So hopefully that title will stay there in 1930s, but we'll see. So this panic came from investments in the railroad. So the railroad would go out throughout the country, and there was good investment to put in a railroad because you have a lot of commerce, a lot of goods moving back and forth, a lot of people moving back and forth easily. So it gets to a point where you have all the railroads to the major cities or major ports. Now what do you do? So if you put in a railroad to a place that and you're not going to move a lot of commerce or people, then it's not a good investment, and that's exactly what happened. So the investments in railroads stopped being something good. So what happened was in 1873, the Vienna stock market crashed. So what did Austria do? Austria said, "Hey, European investors, stop putting money into the American railroad. That's not a good idea." And as a result, on September 20th, for the first time in history, the New York Stock Exchange closes, and they actually closed for 10 days. At this time, 100 banks went under. So then 1890 comes along. The gold reserve maintained by the U.S. Treasury fell to about 100 million from 190 million. So it fell almost half. At that time, remember that the US was still on the gold standard, which meant that if you have a note, then you can go and redeem it for a fixed amount of gold. So the problem is that everybody ran to the bank. And what happened? 340 banks went under trying to satisfy the notes. And at this time, all the asset prices went down big time. Industrial production fell 15.3%, and the unemployment was 19%. It took about 5 years to recover from this. So then the World War I comes along, and Bank of England's precarious liquidity causes them to print out more money. So prices in the US increased 2x, in France 3x, and in Italy 4x. So Europe's inflation was worse than what we had in the U.S. So what happens? That made the U.S. Goods cheap. So that tripled the exports for the U.S. And for the first time in history, the United States has a surplus export surplus of $1 billion. In 1914, Germany comes off of the gold standard. They were broke and they chose the route of high inflation by printing out more money. In 1920, the prices go up 12x. One interesting fact, though, is that the stock market went up 4x. Okay, so keep that in mind. So the hyperinflation in Germany in 1920s pretty much wiped out the middle class. Then World War II comes along, and remember the British still had the money, used in most of the world. So what happens? The Germans try to destabilize their economy by forging notes and dropping them on England. There was a movie about this, Operation Bernhard, and this actually did happen. They tried to do it with the U.S., but weren't able to do it. Then 1931 comes along, and Britain is forced to come off the gold standard. This is mainly because of the Great Depression that they just went through from the 29 to 39. And interesting enough, they published this in the local newspapers, in the Daily Express, Monday, September 21, 1931. Business as usual. Yeah, right. Good news. Yeah, how can this be good news? The internal position of the country is sound. And then in the Daily Herald, you had something like, don't pay more for food. And of course, it says yet. So yeah, right now you're paying the same, but later, who knows? So the pound went Manchurian. It looked the same, it felt the same, but deep inside, it was not the same. Okay, so at that time, what was happening in the U.S., the Great Depression? At this time, remember that the U.S. dollar was on the gold standard. And in 1913, there was the federal law passed the ability for the central bank to only back up his notes with 40% in gold. This was a little bit, gave them a little bit more flexibility, but still they could not generate more bills unless they had the physical gold to back up. And what happened at this time is that, there wasn't enough money on the streets. So what happened is we got a deflation. And in this situation, the sales prices went down because there was not enough money on the street. And the production costs maintained the same or went up. So this is not a good situation, and it caused a depression. Okay, so then in 1930, the Manchurian #1 comes up for the US dollar. So what happens there? The president gets authorized to devalue the gold to the dollar. So now the exchange went from 20.67 troy ounces to 35 troy ounces. So 40% devaluation just by a strike of a pen. And then at that time, 1944, many countries kept the gold reserve, and they started to settle balances between other countries using the U.S. dollar. And most countries started pegging their coin to the dollar, and the official exchange was $35. And then Manchuria #2 comes up, and this is the big one. So again, there was a lot of expenses because of a war. In this case, it was Vietnam. A lot of lives lost. And Richard Nixon, and get this, temporarily, of course, whenever the government does something temporarily, it means temporarily forever. So he ended the conversion of the dollar to the gold. And then, if we look at the gold price in 2 years, the gold jumped from $35, which it had, been for a very long time, under 35, to $42. And then thanks to Richard Nixon, now the world was on a fiat currency. Okay, so everything used to be pegged by the dollar, or most coins pegged to the dollar, and the dollar anchored down to the gold. Now that anchor was cut off, and now the dollar is floating, and by default, everything else is floating. So if we look at the price of gold since then, it was under $20 for a long time. And then, before 1971, it was below $40, and then it jumped up in 1980 to about $600. Then it went up and down a little bit, but today it's at $2,000 plus minus, $100. So if you look at this, ever since 1971, that's a 50x increase, a 50x. So if we take this data and we plot it on a chart starting at 2020 today, we take the 50x, that will be the red line. That means that using the historical goal would be at $20,000 an ounce. If we take the last 15 years, then we're looking at about 5-6K in 10 years from now. But reality is probably somewhere in between this. I think it's pretty clear that gold is going to go up per ounce, silver is going to go up, because this is just a history. Okay, so I got this graph showing the M2 money supply. This is the money that includes cash, checking deposits, money that's easily convertible to near money that you can go out to the store and buy stuff. Okay, it's gone up 10x in the last 40 years, but if you see here in the 2020s, it's shifted gear. It's going up. Now we look at the consumer price index. Here we also see a big increase starting from 1971, which was when Nixon used his pen. And here this is things like food, clothing, shelter, fuel, transportation fares, service fees, things like that. And you can see that, yeah, in 1971, it is going up. So we use that and look at that red line. If, back to 1971, it could have been down here. And now you see that big difference because, resulting as taking off the dollar off from the gold standard. If we go here and we can see here live, what the government, owes, debt. And this is huge, $26 trillion. If you look at this, it's interesting. It's like $1 million per second, pretty much. So pretty crazy. As most of you know, the Fed announced recently that they're going to target a new inflation to about 2% or moderately above 2%. That's something that I've never heard of in the U.S. Before. It's been under 1%, making it attractive to other currencies to peg their coins to the dollar. If you look at the article, it starts talking about around 1.25 or 2.25 to 2.5%. Let me illustrate with what the government is doing with this example of a soup. Okay, so to do an analogy of what the government owes, let's say that this soup here is all the money that the government has to fund the government and not default on loans that many other countries have invested in the U.S. and internal debt. So what do? So you don't have enough soup. You don't have enough to go around for everybody. So the government has several knobs, but this is one of them, which is the inflation. And this is basically what they're doing. They're adding water, okay, to the soup. So now you have enough soup to pay everybody. Okay, obviously at a cost. The soup doesn't taste the same, right? And so countries are gonna start saying, hey, but what is this? I didn't sign up for this soup. But it's a lot of water, and you keep adding water to it. So anyway, the dollar is the same way, right? So it looks the same, but behind it, things have changed. There's a lot more dollars out in circulation, so you have less buying power, and that's what's happening. Okay, so the Fed is saying, inflation is coming. Prepare, right? It's not the end of the world. We just got to learn how to live with it. And by experience, I lived in Costa Rica sometime in my adult life. That's a country with a large inflation of the local coin, which is the colon. But I grew up in LA, and I remember when I went to visit there when I was a kid, the first time I went, my aunt gave me like 25 cents of the local money, and I was able to buy, ice cream and sweets and whatever. And then a couple of years later, I came back, and she had to give me like 10 times the money to buy the same amount of sweets. And that's where I learned, what inflation was. So if you see this chart, there's been years with double digits. The last years have been a little bit more stable. So, what happens in these countries, at least when I was there, I worked for Intel, and my raises were like 8-9% because the inflation was so high. Now you get paid in dollars, the raise is 1, 2, or 3%. So let's compare this, to a situation there. So you have the high inflation money, which is the colon, okay, there on the left, and then you have some stable money, or at least it was stable, and in this case it was the dollar. So when you're living there, you want to use the colones for any type of loan, your home loan, your car loan. Okay, why? Because initially, when you first get a loan, like for your home, you're gonna pay, some high percentage of your salary, maybe 50%, let's say. And after some years, that percentage starts to go down fairly quickly because of the raises are typically higher. And so then by 5-10 years, you're not paying 50%, you're paying maybe 20, 30% of your salary. Now, if you rent in these places, you're never going to catch up because the rent would start to go up every year according to inflation. So if your rent is 30% of your salary, it's going to stay like that, forever until you buy a house. So people tend to, try to buy a house so they can get that, savings from the renting. Now, of course, you pay your monthly bills. If you have a company, you would pay in that coin, right? Now, what do we use dollars for? We use dollars for the savings to invest in companies that generate more dollars, like tourism companies or companies that are exporting things, and of course to purchase things abroad. Okay, you need the dollars to purchase it, things in Amazon or just any other country. And if you're making good money in your business, if there's generating dollars and you want to pay your employees, that way you give a good incentive for them. And some interesting thing is that big ticket items are priced in this coin, in this case the dollar. So if you have a house, you price it in dollars, or if you're selling a car, and then the day you sell it, then you can receive colones at the exchange rate. So that's pretty much what the folks out there do. Okay, so now let's switch it around. Let's say that the dollar is now the high inflation money. So what do you do in that case? So the same thing applies. So you want to have loans in that money, your home loan, your car loans, okay, because inflation is so high, and compared now to the interest rates that are so low, that you're practically getting free money or very low cost money. So yes, get your loans there. Now the same thing applies for the rent, right? So people are going to want to own a house somehow instead of renting, because the rent is always going to be the same percentage of your salary because rents go up. Now, what happens? What's this stable money going to be? It can be a combination of things. It can be virtual coins, gold, or silver. I don't know, but it could be several things. And whatever it is, people are going to tend to move their savings to that. They're going to invest in businesses that transact or are somehow immune to the inflation, like buying a home and renting it out, where you can increase the rent every year and protect yourself against inflation. And then, I wouldn't be surprised that at some point we start seeing, big ticket items or things sold in foreign countries, in something other than dollars. This is a little exaggerated, maybe, I don't know, but you advertise something, in this stable money, or in this case, I put gold because it could be your virtual money. But when you buy it, you would still pay it in dollars, but at the exchange rate. To summarize, I think it's clear that inflation is coming. The Fed announced it. It might overshoot at the beginning a little bit while they get it right. I think historically we saw that gold and silver trend is always to go up, and I don't see why that's going to change. It's probably going to actually be a little bit more accelerated because of all the uncertainty that's coming down the pipeline. I believe that slowly the dollar is going to lose its reserve currency status, and simply it's because countries are saying, "Hey, I don't want this soup with so much water," so they're looking for ways to dethrone the dollar. Higher taxes are probably down the road. I don't see inflation alone being enough. We'll see how that plays out. I do think that house prices are going to go down next year because of all the backlog and foreclosures, and people, unemployed, and in the forbearance program that'll be running out next year. So yeah, the house prices will go down. I do think they'll go up pretty quickly, and the reason is for two things: investors trying to buy houses to rent out to protect themselves against inflation, and the other are folks saying, "Hey, it's no longer a good deal to rent because my rent's going to go up every year. so they'll try to buy a house. And lastly, I do believe that the government, the politicians, are going to try to do something. At least in Costa Rica, about 30 years ago, they were scared of the runoff of the exchange rate, so they made it illegal to sell dollars in the street. They made it illegal to price homes and cars and get loans in dollars. All that changed later, but the point is, politicians always want to try to hold on to the control, try to be able to move these knobs. So if they don't have that option, they're going to try to do something for sure. I'm probably some laws and some changes are going to be coming down the pipeline. We'll see how that plays out, and of course, we'll try to work around those and and adapt. So thanks for joining. There's the data. It's up to you to what you do with this. So thanks for joining, and give a like if you like the video. Bye.